Welcome to Unlocking California Politics, the California Association of Realtors podcast. I'm your host, Sanjay Wagle, and today we're doing a deep dive into the home insurance crisis in California. Today, we are welcoming back two insurance industry experts, Amy Bach, co-founder and executive director of United Policyholders, and Steve Young, who is the senior vice president and general counsel at the Independent Insurance Agents and Brokers of California. Welcome, Amy and Steve.
Thank you, Sanjay.
I wanted to first say that last year's podcast episode that we had with the both of you was our most watched podcast of the year. So clearly people are interested in our topic, and I'm honored to welcome you both back today to discuss what's happening with the current state of homeowners insurance in California. Since we last spoke, there have been a number of companies that have actually stopped writing policies in the state, most notably State Farm, which attracted the most media attention. But others are also stopping, and we're hearing increasingly about other companies who are still issuing policies who seem very ready to drop homeowners who might not qualify or have any type of little problem. And so it's creating a growing sense of crisis, at least within the state. We also hear many of our members where homeowners and prospective buyers are having difficulty obtaining insurance and increasing use of the FAIR plan. So I'm going to start off with insurance companies often talk about the difficulty in getting necessary rate increases in California. And two issues which keep recurring in terms of insurance industry requests are to be able to incorporate within their rate structure forward-looking risk modeling and reinsurance. So I'm going to start with forward-looking risk modeling. And first of all, and I'll start with Amy, what is it? And why do insurance companies want it? And then Steve, we'll go to you.
So thank you so much, Sanjay. So forward-looking modeling would be, we in the business refer to them as CAT models. And that would be a product that a vendor has sold to an insurance company that purports to predict into the future. So extrapolate from the past, but also load in algorithms based on science and projections, economic projections, to say that it is likely that this will happen in the future. So they're basically predictive models. And there are two kinds of models that are in play. There are underwriting models. That would be something that a lot of your realtor members might be familiar with, because it's getting more and more publicity. Would be a Fireline score, a risk score, right? That would be the number that's placed on a structure. That's an underwriting model, right? CAT models are rate models, right? So in California, insurance companies have been able to use the underwriting models, Fireline score, CoreLogic score, but they're not allowed to use CAT models, which would be a rate model, because we have a regimen here in California where the Department of Insurance is charged with reviewing rate filings by insurance companies and understanding the assumptions in those rate filings. And those rate filings, there only are a certain number of rating factors that can be permissibly used in California, because we have not just rate regulation, we have what's called prior approval, right? The department has to approve the rates, but we have Prop 103 in California. Prop 103 enumerates the allowable rating factors. So we have a unique system here in California. And currently, because CAT models have a lot of people will talk about them being black box models, there are assumptions built in and the algorithms built in that are proprietary. And so the Department of Insurance has been saying, A, they're not one of those permissible rating we can't use them. B, we can't see what's in them. And therefore we're not going to allow insurers to use them. And insurers have been on a very steady lobbying campaign to be able to use CAT models.
Stephen, do you have anything to add to that?
Well, I do. Number one, Sanjay, thanks for the opportunity to be with you here today to talk to your membership. Sure. And Amy, it's always a pleasure to see you. Have a lot of respect for you and your organization, even if we don't always see eye to eye on every issue. To just set the stage a little bit, Sanjay, and I won't take long in doing this, but consumer groups frequently say that property insurance in California has been hugely profitable for the insurance industry. They make that allegation all the time. And you know what? They're right. It has been. Historically, it's been a hugely profitable line of insurance for companies. But what has changed dramatically starting in about 2016 in California has been the emergence of this absolutely catastrophic exposure to wildfire loss, which is unprecedented in its magnitude, both financially and just geographically. In California, since 2016, insurance companies have paid out over $30 billion in claims just in California, solely related to wildfire losses. Those sorts of losses are not sustainable. You cannot continue doing that. And there's a whole bunch of reasons why that's true. Global warming. I think it's almost a misnomer to talk about global warming. We're not dealing with climate change. We're not talking about global warming. We're talking about weather catastrophes, which you can see on just about any point on the globe that you pick today, from Hawaii degrees to here in California. The climate scientists are telling us that this is not an isolated phenomenon, that these extraordinary periods of drought, the extraordinary fires that we're having to deal with, all the other conditions are not only going to not stay the same, they're going to get worse. You've got that. You've got this very significant population growth in the wildland-urban interface. We know, especially in California, there's massive forest mismanagement over time. So there's just tons and tons and tons and tons of dead trees. You've got all the population growth. You've got all of these factors that are driving these massive losses. And so what we have to recognize, I believe, as a matter of public policy, is that the business of writing property insurance in this country, both residentially and commercially, has changed inexorably for the worse. Nobody wants to pay more for insurance, but the nature of these losses are so extreme. They are so catastrophic in nature that we cannot continue what we've been doing if we want a different result. And the reason that insurers have been withdrawing and retreating from this market is because they need really two things. Insurance companies need two things in order to write insurance. They're very good at assessing risk, but they need two things. One, they need adequate rates that are commensurate from an actuarial standpoint with the risk they're being asked to write. And number two, they need timely decisions from the regulator. And they're not getting either one of those from this Department of Insurance, and they haven't been for a number of years. Now, turning specifically to modeling, Amy's exactly right. There are these two different types of rate models. The reason it's relevant here is that California's prior approval laws have kind of a unique feature to them. There are several unique features to them, but one of them is that insurance companies are required to base their rates solely on their own historic loss data. You can't use what you think you're going to have to pay in the future in claims. You're limited solely to this sort of rear view mirror look. And that's okay. I think you can get away with that as long as maybe getting away with it isn't the right articulation. But you can survive in that business climate if the loss that you expect is more or less predictable and consistent from time, from one year to the next. And it really has been in property insurance for a long time, but not since 2016. And so that's why insurers, actuaries, other experts say we must allow insurers to incorporate, not exclusively, but as one factor in the commissioner's evaluations, the expected future losses and what that means for rates.
Stephen, Amy sort of explained the way the algorithms work and those models work. I think one concern would probably be is the transparency of those models in terms of figuring out what assumptions might be built in. Are they accurate assumptions? Are they something they could question? What are your thoughts on that? Would the companies that are involved in that be willing to say, let the Department of Insurance take a look at under the hood, if you will, of those algorithms?
Well, let me say that I know enough about computer science and these algorithms to be dangerous to everyone within the sound of my voice. I know nothing about it. But there are provisions in Prop 103 that require all components that go into rate making to be open to public inspection, so there can be appropriate scrutiny. And I'm confident we can find a way to reconcile, on the one hand, that imperative towards transparency and towards openness with, on the other hand, the sort of proprietary ownership interest that some of these companies have in developing these systems. I think it's important to note, just as Amy said, that there are different types of modeling. Modeling is used for different purposes, right? And the modeling that's used for underwriting or just in risk assessment, those systems are not new. They're not scary. They are widely used, even in California. I mean, the California Earthquake Authority uses them. Cal Fire, the Department of Forestry uses them. They're very commonly used. It's just the rate component. We've got to figure out some way to sort of, again, balance that. If I'm a private company and I've invested an immense amount of money in developing this predictive software, there's a proprietary element to that. Mm-hmm. They don't want their competitors to see how they're doing what they're doing, right? It's a competitive business. So there's got to be some way to do it. And California is the only state, or one of the only states in the entire country, that doesn't let insurance companies use these models for rate making, and other states have addressed these issues. There's a variety of different ways that you can do it, and the Department of Insurance actually held a workshop, which Amy testified at, so did I, a few weeks back, where some of those different methods were reviewed. There can be independent commissions that are appointed by the commissioner to kind of review it almost in camera, if you will. It's possible that we could develop some sort of a University of California sort of system that everyone recognizes and uses. There's a way to do that, but it does. I will admit that it does require some thoughtful analysis to reconcile the need for transparency with the proprietary interest.
Now, Amy, given the fact that the state of California is basically making significant expenditures, changes to the way we live in many ways in order to address, climate change, and then it's basically a sort of, mantra for the whole state in many areas. What do you say about the ability to use such forward-looking risk models, given the fact that climate change does seem to be resulting in more extreme weather events and less predictable patterns?
Yeah, so I think we've got a problem of trying to find sort of a middle ground here, right? I think that it is true that that the CEA uses CAP models, and the FAIR Plan is allowed to use them. So my organization has not been ever said, this is out of the question. We're not Luddites saying, we don't believe in new approaches and predictive analytics. I think our concern, and that's the same concern I'm sure that your members have, is that in a lot of parts of the state, people are already having rate shock, right? They're paying triple, quadruple, when you hear the premiums that people are already paying, condos as HOAs, going from $50,000 a year to $500,000 a year, and, just really extreme price spikes that people are dealing with now. Our concern is when we look at how CAP models have caused rate shock in some other areas. We're just scared about, frankly, for the property owners of the state, in terms of if the rates are already where they are now in a lot of these these suburban and rural areas, what is going to happen when insurers are allowed to use these commercially developed models? And, we look at, for example, the flood program, where they adopted something called Risk 2.0 a couple years ago, and it has been so controversial that 10 states have sued them to block it because the rates that the CAT model put into place caused such shock, rate premium shock. So that's just a basic. I mean, we're not expressing concern because we feel that we have to stick to the past. We recognize, and I think most people in California recognize that risk has increased, right? People, we've had now, starting in 2016, we had a series of mega fires. Of course, we've had a break the last few years, which is really important. Similar to how Florida had a break for a while. They had a couple of years where they didn't have a lot of bad hurricanes. Now they're getting slammed year after year. So I think, property owners will recognize, okay, I get it. I'm going to have to pay more for living where I live, right? But the question is, how much more is fair? Because what we're really concerned about, and I know elected officials are concerned about it, I know your members are concerned about it, is since people are already struggling under the weight of premium increases, how much worse can it get? And that's really the essential fear that we have, right? And I think there's a middle ground. In my testimony at the first hearing, and the department's going to do another round of hearings on CAT models, we said, well, there's another way to do this. And this was a concept that one of my staff members came up with, which is, he worked at the Department of Insurance for a long time, which is, okay, so insurers, let them not just use their experience from their book of business and the claims that they paid, but let them use their competitors' experience as well. So let that be the basis for the CAT load that they can put in to their rate base. So we feel like there's an alternative. I'm not sure we've gotten the attention for that concept that we would like to get. I think, we all know there's all these negotiations going on. I'll be honest with you, Sanjay, I'm from Brooklyn. I'm a deal maker. I came back, years ago from an NAIC meeting talking to, state insurance regulators. And of course, everybody's been complaining about, prior approval, insurers are like, we like Nevada where we can get our rates, we can start using our rates, or 3 weeks after we file or whatever. Right. And so, definitely I came back and said, hey, do we have room here to negotiate on their 2 wish list items, right? Getting reinsurance, being able to pass along reinsurance costs to their customers and using CAT models. And I think the department very responsibly said, hey, we want to have a robust market here. I mean, it's not like the department is happy about the current state of affairs. They're looking for solutions too. But they need to protect consumers, and they cannot allow insurers to overreact. And that is the core of what we're trying to figure out here, is like, to what degree are insurers overreacting, and to what degree are vendors fueling that overreaction?
Okay, thanks, Amy. So we're going to move on to reinsurance, but I am going to take it as a cause for optimism that there seems to be at least maybe there's something here on that one. So we're gonna take an optimistic look that there looks like there's some room for compromise on that. The next one I'm going to address is reinsurance, and we'll start with you, Stephen. Can you explain in layman's terms what is reinsurance, and why do insurers want to be able to incorporate reinsurance costs in their rate filings? Which, by the way, just real quick, is not allowed in California, and I think we're one of the few states that does not allow it.
Yeah, California is the only state, to my knowledge, that does not permit insurers to use their reinsurance costs in rate filings. Reinsurance, the whole notion of insurance, as you know, Sanjay, as your listeners know, is about spreading risk. And the more severe or the more extreme those risks are, the more important it is to spread it as widely as possible. So you'll sell off a certain layer of exposure to one group of insurers and another layer perhaps to another, and then a higher level still way beyond. And so it's an essential part of the insurance mechanism. To answer that question more fully, I want to posit a hypothetical for you and for your listeners. So bear with me for a second. We all know that in California, there is a lack of housing right now, right? There is an absolute housing crisis. The governor, the legislature, other policymakers are focused on it. Let's just say hypothetically that I decide that the cause of this housing crisis in California has nothing whatsoever to do with the laws of supply and demand. It has nothing whatsoever to do with high interest rates. It is all primarily the result of exorbitant, outrageously high real estate agent commissions.
All right, this ends now. Just kidding.
That's what's causing the crisis. Now, parenthetically, Sanjay, I feel like no insurance agent commission can ever be too high. And perhaps you feel the same way about real estate agent commissions. It's impossible to even get too high. But let's just say hypothetically, that's the political dilemma. And so there's an initiative passed that creates a real estate czar who is given the power to absolutely set every real estate agent commission for sale. And they develop regulations to determine what the maximum commission can be in every case. But this czar decides to just exclude all marketing expenses that a realtor might have to pay and caps staging or other expenses that go into making the property as presentable and desirable as possible. I've just described to you Prop 103. I mean, that's exactly what Prop 103 did to the property casualty insurance business. And by excluding all of an insurer's legitimate and necessary reinsurance costs, it's designed to suppress rates, but it does not produce a fair or accurate measure of an insurer's profitability. And that's just one example, by the way. Prop 103 said one thing, but then the insurance commissioner promulgated regulations to implement it, which in a variety of different ways either overstates insurer revenues or understates their expenses. And again, just to come back to the central theme for today, you can live in that environment as long as losses are predictable and consistent. But in an environment where they are suddenly blowing up, where suddenly there is no predictability and the losses are so utterly catastrophic, you just can't do that. So the reason that insurers, actuaries, and others say the single most important thing that we could do to restore the health of the property insurance market is to give insurers credit for the reinsurance costs that they incur on California-based losses, exposures. That does more than probably anything we could think of to try to promote rate adequacy. And one other thing I'll say, I know Amy's chomping at the bit, but one other thing I'll say, she mentioned in her comments that, we're seeing in HOA or condominium liabilities, premiums go from $5,000 to $50,000. In some cases, it's even more extreme than that. I mean, there's no question that there is an absolute crisis in availability and affordability. But where a premium has gone up that much, it's because the policyholder, the insured, has had to go into the non-admitted market. And every state has a non-admitted market. Those companies are not subject to Prop 103. They're not subject to the same authority of the commissioner to review, rates and approve those things. But even those companies are not writing in these areas that are most prone to wildfire. They can charge anything they want. They can write any type of policy they want. They can impose massive deductibles or just exclude things from coverage. They are limited only by their own imagination and what they think the market will bear. But even those companies are not writing property insurance in these areas that are most prone to wildfire. So our hope is that if reforms can be enacted, that it will restore the admitted property insurance market. And yes, prices are probably going to have to go up. I don't think there's any way around that. Nobody likes it, but when you've got $30 billion in claims paid just related to wildfire, just in California over a really short period of time, rates have to go up. So our hope is that if these reforms are enacted, if reinsurance can be appropriately factored into the rates, that will restore a competitive property insurance market in the admitted market. And that in and of itself, we think, will expand consumer choice and drive prices down.
Amy, I'm sensing skepticism, but
well,
go on.
I mean, first of all, the 30 billion that Steve has referred to actually is less than that, because that doesn't include, for example, the 13 billion that insurers got from PG&E in a settlement that offset a lot of what they paid out on the North Bay fires. So it's not like insurers are not getting to factor in their own business operations the benefits they get from the reinsurance they buy. I just don't think Steve's, by the way, I work with a lot of Steve's members. I have a lot of respect for Steve, but I hear very different stories from some of his members that are on the front lines, right? I think that it's not, equating reinsurance costs to a commission it's apples and oranges, right? It's really reinsurance is the insurance that insurers buy, right? And the reason that consumer advocates and the department have taken the position that it's a cost of doing business that insurers need to work into their own budgets, not pass along purely, is because reinsurance rates are not regulated, nor are their forms. And what's happened in recent years is that reinsurers are starting to get much more into the micromanaging of their insurance customers' business, right? So now it used to be that they would do national treaties, insurers and reinsurers would do these national treaties. Now they're much more localized treaties. And I understand that many reinsurers are saying to their primary insurer customers, we don't want to see any customers in your book of business that have a risk score of above a 7 or something. So reinsurers are driving a lot of what's going on here. And it's been a hard reinsurance market for the last few years, meaning that reinsurers have upped their prices by a lot. And that is impacting insurers. So there's no question that reinsurance is a big part of what's happening here. But again, we have to find that middle ground, right? Because you don't hear insurers reporting on the offset that they got against their paid losses from their reinsurers, right? That they don't report that. So that 30 billion actually is probably more like 20 if you take out what they actually what the amount of their losses that got paid by reinsurers. So that's one thing. I mean, another thing is just the fact that this whole thing is smelling weirder and weirder to me, right? Meaning, why would unregulated, non-admitted insurers that don't have to go through Prop 103, why would they be showing the same reluctance to be writing properties in these areas as admitted companies who are subject to regulation? Well, one answer, I think, is some of the non-admitteds are actually subsidiaries of admitted companies. So they have the same agenda here, which is dismantle Prop 103, dismantle prior approval, fast track our rate increases, and let us be free to operate as we do in other states. And again, I think, Steve, we're just trying to find a middle ground here. For me, I don't, like I said, like I would like to find a way to fix this situation that's not going to make it worse. And that's really where we are. We're kind of like, I just don't, I know that insurers have hated Prop 103 since the day it was passed in 1988. They have been trying to undo it for the entire time. So there's a part of me that's really like when, in Consumer Watchdog, my organization is very different from Consumer Watchdog. First of all, we don't intervene in rate cases. Like for us, we feel like the Department of Insurance has a professional staff. That's their gig. Fine. Consumer Watchdog intervenes. That's not what my organization does. And so for me, like, I don't have a philosophical objection to insurers being able to pass along costs. What we're looking for is appropriate guardrails so that a situation that's already really bad doesn't get worse. And what I haven't heard in any of these negotiations is if the insurers get what they want, let's say the legislature figures out a way to avoid the 2/3 majority vote that would be required to change Prop 103, right, which was a ballot measure. Let's say they figured it out. What guarantees are insurers willing to offer that they will come back, that they will renew, that they will give appropriate mitigation discounts? I haven't heard any concessions like that, and we certainly didn't see them in Florida for all the tort reforms that got done in Florida. No concessions about insurers saying, okay, if we get this, if the legislature gives us this, or the regulator gives us this, we will commit to coming back. And without those guarantees, I just see it as a very risky proposition for the state right now to just sort of give insurers those blank checks to use cap models and pass along reinsurance rates.
Okay, Stephen, before we move on from reinsurance, I'm just going to give you an example so that I can understand this, and I think hopefully some of our listeners. I happen to live in a very low risk part of our state and our region, and we have very, very reasonable insurance rates. So if, say, reinsurance was obtained primarily due to the huge fire losses, what would happen to me?
Well, there is a difference, Sanjay, between a rate and a premium. The rates that insurance companies use, which are subject to prior approval by the commissioner, are kind of the overarching sort of financial structure, and then individual premiums are sort of personalized based on where a property is, what the risk profile is, et cetera. So in assuming there are, in fact, any low risk areas in California these days.
I'm in it.
Yeah, that's what everybody says, Sanjay. I'm in it. But assuming there are, you should never be paying as much as someone in a high risk area. I mean, that's the whole idea of insurance, that there is a relationship, an irrational relationship on the property casualty side of things between the risk presented and what an insurer company is required to sort of charge from an actuarial standpoint to do that. And so, look, again, I don't like saying this, and I don't like what it means for me personally, but insurance rates are going to have to go up. You know, Amy expressed skepticism about why non-admitted companies aren't writing. Well, I got 30 billion reasons why, Amy, or 20 billion using your calculations. Nobody wants to sign up for that level of almost guaranteed loss. And the other factor, Sanjay, and I know you're familiar with this too, and we haven't talked about this a whole lot, is the California FAIR Plan. The California FAIR Plan is an absolute, it's not even a time bomb. It's like a thermonuclear bomb that's waiting to go off right now. The FAIR Plan, you know, was created by the legislature in the 1960s to guarantee, to ensure that if people could not get at least basic fire insurance, just basic property insurance on their homes, that there would be some way, there would be some outlet for them to get insured, right? And so over time, the FAIR Plan has been expanded from the inner city and then from brush areas to statewide. And right now, the FAIR Plan is pretty much the only sort of source for property insurance in a whole bunch of the state. It provides very minimal coverage. There are coverage caps, and there are a whole bunch of other limitations. But the FAIR Plan is itself not an insurance company. It's basically a private association of insurance companies themselves. It's like this hybrid sort of entity that is carefully regulated by the Department of Insurance, but is actually run by the insurers whose companies write all the property insurance, right? They, right now, and this was as of May, so the actual number now, as we approach September 1, is probably substantially larger. But in May, they were reporting they had $225 billion in potential exposure to claims. Because the FAIR Plan is riding in all the areas where nobody wants to touch any type of risk. Lake Tahoe would be a perfect example, or the Malibu, Pepperdine, those areas, Big Bear, all those areas. Because the FAIR Plan is not a company, they don't even begin to have the resources on hand to pay claims if there was an absolute catastrophic loss. So the way the laws are set up currently, the FAIR Plan has the ability to essentially impose assessments on insurance companies based on their market share to pay their portion of, catastrophic FAIR Plan losses. The reason that is important and the reason it is driving, we fear, some of the marketplace retrenchment that we're seeing is that not only do these insurance companies have to pay their own claims, if any, in an area where there is a fire, but they then have to pay a potentially just huge assessment from the California FAIR Plan. And right now, those assessments are not apparently recoupable. So companies just have to eat that expense. And for smaller companies, if you're a big company like State Farm or Allstate, you can absorb that. But if you're a smaller company, especially the independent agency companies who are served by my members, that could put some of those smaller companies out of business, just because, again, the magnitude of exposure. So that's another factor, Sanjay, that has the potential to affect your rates even in a low risk area.
And so let me segue that to Amy. Currently in the lower risk areas of the state, even though State Farm and some of the bigger carriers have stopped writing policies or are not writing as many policies as they may have previously, there are a number of smaller or medium-sized admitted carriers who are offering insurance. In many cases, you might lose State Farm, but you get another company that's admitted. But one of the concerns I've heard is that as those companies start to expand market share, they might be concerned about the possibility of a FAIR Plan assessment, and that might limit the scope of their expansion or ability to take on. If the larger carriers stop writing as many policies, they may still not be able to take up the market slack at some point. What do you have to say about that?
Well, in our presentations that my organization does all the time in communities to try to help people navigate the crisis and make good decisions, we do explain the difference between an admitted company that's protected by CIGA, the California Insurance Guarantee Association, and then a non-admitted company that is not. I think that interestingly enough, what's going to probably happen, and I'm sorry to break this news to you, Sanjay, but I think that whatever deal, if there is a deal that gets cut, the pain is going to be spread across the state. And I think that there's going to be, this is what we've seen, we've seen in a lot of other states where we've had similar issues. Alabama, where there was sort of like not exactly a fight, but kind of between homeowners in the coastal areas who are saying we're staggering under the weight of these of the premiums, that the CAP models in some ways have had unleashed on them. And then the inland people were saying, well, we don't like it either because we feel like now we're having to carry some of the risk. I mean, I think, I will say we're all in this together in the sense that no matter where you live, there's risk, right? People in the country don't have the same risk of being broken into that somebody in the city does, right? But we don't, in the city, we don't have the wildfire risk, right? To a certain degree, we're all going to be bearing the pain of what climate change is bringing, right? It was this part of what's going on here, right? So I think that, again, we're looking for some sort of a reasonable balance here. I think the insurers, to me, look, they're overreacting, and I get it. But like I said, we've had a couple years where we didn't have any mega fires. And even when you add up all the total losses from the 5 mega fires, Camp, Tubbs, Thomas, Woolsey, and Atlas, and then you add all of those up, the total losses, it's still under, it's under 30 or 40,000, right? And there's 15 million insured homes in California. So, again, this is really, I get it. No for-profit company likes to have losses. I get it. But I really believe, after, years of trying to tackle this problem, that the tech tools and the scoring and the reinsurance prices have really knocked insurers back on their heels in terms of doing what they do, which is to underwrite risk. So I just think that we have to find our way back here, because, I agree with Steve. The FAIR plan, no panacea, and I will say this, it's very hard to even find out the names of the governing committee of the FAIR plan, or a whole lot about it, right? There's one public member that has no vote, and they did give themselves a distribution not that long ago, right? So the member companies, right? So I think that, definitely the FAIR plan is cause for concern. I'd love to see the non-admitted companies protected by CIGA. I'd like to see them contributing to the FAIR plan in some way. I don't think that's happening anytime soon. So again, we're looking for that sort of middle ground where the pain gets spread fairly and reasonably.
So both of you are involved. I think, Amy, a couple of times you've said that there's room for maybe there's room to meet halfway or something like that. Is there the possibility of, do you think there's the possibility of either through the regulatory or legislative process of something that would help stabilize or increase I think you both have indicated that it's likely, due to various factors, that overall costs will likely increase for consumers. Yeah. But is there some possibility that we could get more availability, at least, and still affordable, even if higher insurance? That there's a room for compromise between, and I'm sort of using you guys proxies, but between Steve and Amy to reach an accord in this. Is there room for a deal, either as a regulatory or legislatively? I'll start with Steve.
Well, I think if it was up to Steve and Amy, we could probably have solved this problem 2 years ago, to tell you the truth. And I think we both tend to be either more reasonable or more naive, some of our respective colleagues, at least on some issues. The one thing before I answer your question directly, Sanjay, I want to come back to, because this is really important. You made the comment earlier that there are still a number of smaller or some insurance companies writing. I don't think that's true. That the insurance commissioner and his minions frequently say there's over 100 insurance companies writing insurance. That is demonstrably not true. They are using market share data from 2022 that does not capture any of the retrenchments that we've seen in the last 19 months. So I'll let your listeners draw their own conclusions about the competence and or veracity of the commissioner's office on that point. But there is an absolute crisis. And I'll tell you that independent agents, because in personal lines, our companies were feeling this pressure and had less financial capacity to sort of withstand it than the big guys like State Farm. We were aware of this sort of crisis, 9 or 10 months before it became, I think, more readily apparent. I think there is room for a compromise. As I said earlier, insurance companies really need two things, and this is easier said than done. But they've got to have adequate rates from the regulator, and they need timely rate decisions. the department admittedly is understaffed in this area. And let me say too, it's very easy to criticize the commissioner and the Department of Insurance, but my experience repeatedly has been that the California Department of Insurance is full of incredibly dedicated and knowledgeable public servants who understand the industry, who work very hard, who want to do what's right for the state in balancing the competing interests of the consumers, the agents, brokers, the companies, and everybody else. So I really tip my hat to the department for their very hard work in a very challenging environment. I don't know if Amy would agree with me or not, but I've been in this position for over 30 years, and I've never seen either a marketplace that was as broken as this one is right now, the insurance marketplace, or whose underlying causes were so difficult and expensive to try to remediate. This is a real hard set of issues. But I'm confident that there is a way to find middle ground. And I'm also confident that if insurance companies are given these additional tools, subject to the commissioner's approval and monitoring, that there will have to be, and there will be, firm and enforceable commitments to start writing more insurance. I can tell you, as an advocate for agents and brokers, we want to see companies writing more business. It's not just a matter of helping their bottom line. My members aren't going to Ohio or Nevada or other states. We're right here in every California community. And so, that's something that we are supportive of. But with the very difficult political decisions that have to be made, I think it's going to be very difficult to find that common ground. But as we've alluded to in this discussion earlier, there have been a number of very high-level negotiations over the last 2 or 3 weeks, and there seems to be a consensus emerging on a package of proposals that would give the insurance commissioner express statutory authority. I mean, he probably has it already, but this would even clear the decks further for him to do emergency regulations that he could write and craft as he sees fit on rate modeling and on reinsurance that would attempt to expedite the prior approval review process, and would try to shore up the funding for the California FAIR Plan, all of which are things that we support. So whether or not that gets companies back or gets them back right away, I think is open to debate. The fact of the matter is, even if you do emergency regulations, even if there's some consensus about what you do in those regulations, they're subject to challenge, and they are subject to, even on an emergency basis, a lot of time to prepare and get on the books. And then even if you've got that solution in place, then insurance companies have to file new rating plans and get approval for all of the modified rates that they want to use. And that's a process, even if the department can expedite, its reviews and hire more people and get them trained and all that stuff. That's a process that it's hard for me to see that being really hitting the streets in terms of something that's effective in less than a year. And I think even a year is probably hopelessly optimistic.
Amy?
I know we're going to have to find a solution because this is it affects our economy. It affects, housing, real estate transactions, and then people, in their pocketbooks, right? So there's been a lot of media coverage in the last couple of weeks about people going bare, people who've paid off their mortgages opting without it. I think everyone wants a solution here, right? I don't think there's any of the players that are going like, I'm fine with this continuing the way it is, right? I don't think anyone's really benefiting right now from the mess, right? So I think that I don't think that the world's going to end if the department says that insurers can use CAT models. I don't think the world's going to end, if the legislature gives the commissioner the authority to allow some amount of reinsurance to get passed along. But I think the bigger, more important solutions are not just to kowtow to the insurers because they've created havoc right now, honestly, and they've made Steve's members' incomes, plummet, and there's a lot of desperation among agents. It's a horrible, horrible time, with professionals who feel humiliated. I can't serve my clients. I can't. It's all my professional skills are nothing is serving me now. I really, they don't like to put people in the FAIR plan. So I think that there's so much desire to craft a solution here that we'll have something. But I think that long term, we're going to need a public model that will be sort of a benchmark against these privately built models. I think we're going to need something that Glenn Pomeroy and I had worked on years ago for the CEA, the California Earthquake Authority, which is they have to buy a ton of reinsurance at retail, the Earthquake Authority. And that doesn't make any sense, right? Because the CEA is a take all comers. So is the FAIR plan, basically. They don't really get to underwrite. They have to take the customers that come to them unless, the property has really serious flaws. Yeah. So that means they're serving a public purpose, right? There are, and that means that in my view, there should be something like COGA, what was what we worked on some years back, a congressional obligation guarantee, which would be on the state level. That would be to say that the FAIR plan and the CEA, they don't have to buy all their reinsurance retail to meet their solvency requirements. They can buy reinsurance, but then they also will have a guarantee that if there's a big catastrophe and they have to pay out a lot of losses, they will be able to borrow from the government at a low interest rate to meet their obligations to their customers. So I think those two, we have some long-term solutions we need to put in place, because I don't really think that the pure for-profit property insurance model is going to ever fully come back because of what we're seeing with climate change. That's my view.
Okay. Thank you, Amy. Thank you, Steve. I appreciate both of you being here. And before we sign off, we have run a little long, but before we sign off, I don't know if this is a lighter note, but I am going to start with Steve and then Amy, just briefly. What's with the drones? We're hearing about insurance companies flying drones over people's properties to check out and then going, oof, you're denied. What's going on?
Well, Sanjay, I can't speak to that specifically. I think I hope you've learned your lesson and will at least wear a Speedo when you're in your backyard now. Insurers are increasingly using new technologies in both underwriting and in claims handling, and they've actually been able to realize some pretty amazing efficiencies. Because you can use drones if you're riding, say, a commercial microwave tower or something like that. You can do the safety inspections and all that with those. So those are pretty amazing. But I can't speak specifically to problems with drones in part because, as Amy said very eloquently, our members are desperate for markets right now, and all other issues kind of pale by comparison.
Thanks, Steve. Amy?
Yeah, just, from the time that insurers started buying drone imagery and then deploying them, we were like, this cannot be good, because sure enough, they can see your propane tank and the wood pile next to the propane tank. They can see the tree hanging over your house. I mean, let's face it, they were taking properties as is now for decades and decades. And now, I think homeowners are having to step up. And that's why our organization is pushing mitigation so hard and, trying to do everything we can to, help communities around the state get BRIC grants and put these programs into place, because I think, we're fine with homeowners, look, do their part, right? You do your part. This is your asset. So it's on you also to fortify it, create defensible space, put the time in. And we're looking at all the programs to help people do that. But, we need insurers to come to the table and say, and when you do that, when you do those things, when you reduce risk, we will reward you. And that's what we're looking for. Is for everybody to contribute and for this the burden to be equally spread, and for insurers to to do what they do and come back. I mean, my goodness, all these people say, I've been paying premiums for 30 years. I never filed a claim. I never even used this product. And now I got dropped, and the only thing I can get back is the state program that costs like 4 times what I was paying. So yeah, we gotta do better, and I believe that we will.
Okay, thank you very much, Stephen and Amy. And I do have I feel cautiously optimistic after talking to both of you. So maybe we'll revisit this and see where we are in 6 months to a year. So thank you again. And as I said, I do look forward to having a future conversation with both of you.
Pleasure
Thank
to
you
be
so
with
much.
both of you.
Thank you, Sanjay. It's a pleasure to see you both. Thank you.
All right. Thank you.
Take care. Bye, everyone.
Disclaimer. The purpose of this podcast, brought to you by the California Association of Realtors, C.A.R., is to provide general and educational information and opinions from a wide range of perspectives regarding politics, voting, elections, legislative issues, and more. The opinions, beliefs, and views expressed by guests or participants of this podcast are solely their own and do not necessarily reflect the opinions, beliefs, or views of C.A.R., its affiliates, their respective directors, officers, or employees. Reference to any individual or entity does not constitute an endorsement, recommendation, or any other position or opinion regarding that entity or individual by C.A.R. This podcast does not constitute professional advice or services of any kind. This podcast is available for private, non-commercial use only. You may not edit, modify, or redistribute this podcast.